If you think you can't buy your first home because you owe $250,000 in student loans, you could be walking away from a great house and stay trapped in renting when you don't want to. The key is lenders don't care that you have debt. They care about hidden math formulas on how that debt is structured. And there are massive loopholes for income driven repayment plans that most buyers are not aware of. I'm Julie Marion, founder of the First Time Homebuyer Workshop, and we are so glad you are here today. There is a massive amount of information you need to master before you say the words, I'm going to buy a home. Here in this community, we prepare our first-time home buyers to step into the home buying process prepared, savvy, and knowing what to do and when. Our goal is simple: to reduce homebuyer remorse, which is well over 50% annually. Instead, let's empower you. Congratulations are in order if you have graduated from college. You have a bright future ahead of you. You may have even landed that job you wanted, rented for a few years, and you're just ready to have a place of your own. And you're thinking, how will I be able to buy with all this college debt? Well, the good news is lenders look at college debt in many different ways. So we're going to break all of these different components down. Let's break down first that the lender, right off the bat, is going to calculate your debt to income ratio. It's also called DTI for short. And they like to see no more than 45 to 50%. And know that 45 to 50%, they're talking about gross income, not after your deductions for your health care, your retirement, all of that. So it's gross income. Now, with that 250K, how this hits your DTI depends entirely on the school debt payment plan and the type of mortgage loan for which you are applying. So they're both in combination with one another. So the school debt payment plan, I'm going to cover this in detail at the end because there are several specific steps you need to take or confirm. And why this is important is that if you have 250K of student debt, the income driven repayment plan, it is the wild card. It's your golden ticket. So if you're applying for a conventional mortgage loan and you are on this income driven repayment plan, you will have an official IDR statement. And what that report shows is your monthly payment. So let's just say it's zero due to low income relative to the debt, or it's heavily reduced, say maybe $150 a month. Conventional underwriters will use that actual number. And this is a massive win for your DTI. So think about this. You have $250,000 in debt and the payment is either zero or $150 a month. Just right there, you have just bought yourself more home buying power than you probably thought. Now, if you apply for an FHA mortgage loan, it's completely different. The FH rules are much stricter. Even if your credit report says that you owe zero, the FHA underwriters are legally required to calculate 0.5% of the total balance for your monthly debt. So for 250K, it's automatically going to translate into 1,250 monthly payment, regardless of what you actually pay. And that really stinks. And it's kind of a lot, especially if you have something like a car loan. And if you have a car loan, you need to watch this video too. I've linked it also at the end. So watch this all the way through so you don't miss any details, because the devil is in the details always, right? So just to recap here, the lender prefers the maximum of 45 to 50% total DTI, which includes your future housing payment. And that payment is principal and interest, taxes, insurance, any PMI, student loans, credit cards, and any car payment. So let's look at a hypothetical situation and assume $100,000 in annual income, which is $8,300 gross monthly income. The max debt allowed is 45 to 50. That's $3,750 per month total, right? Subtract, let's say the car payment's $400. Subtract the student loan. If you're on that conventional IDR plan, as an example, let's say it calculated out to $200. Well, the remaining balance for your mortgage payment is $3,150. Now, this is a very healthy mortgage payment amount. With a target budget of $3,150 for your PITI, principal, interest, taxes, and insurance, you're looking at a maximum home purchase price of approximately $410 to $430. Now, these numbers are general based on nationwide averages. Of course, you will have to calculate this for your area, but I'm just trying to give you an idea and show you some examples hypothetically. Now, let's look at the same income with an FHA loan. This income is going to be the same, 100K. The debt to income ratio is going to be the same. So you're going to be allowed $3,750. You subtract your car payment, which is $400. Then you have to subtract the student loan rule debt under FHA of 0.5, and it's $1,250. And remember, it's so much higher because these rules are more strict with FHA. So the amount of money the bank says that you can spend for a mortgage under the FHA mortgage loan is $2,100 that you can spend for your mortgage payment is $2,100 a month. This significantly reduces the price of the home you can afford, because if your maximum monthly mortgage payment is $2,100, your target home purchase price shifts down from $400-ish to approximately $260,000 to $280,000. And this is why the income-driven repayment plan for federal student loans is so exciting. Now, you have to apply directly through the U.S. Department of Education, and lenders will eventually need the official IDR plan approval letter or printout from your Student Aid Gov dashboard website showing your calculated monthly payment to verify this DTI ratio. And this can take a while. So while you're getting your ducks in a row for this transfer of this debt and recalculation, and the time is ticking on your lease, go ahead and take the first time home buyer workshop so that when your finances are all lined up, you are ready to shop for a home. Here is the exact step-by-step process to get enrolled. Step 1, verify your loan eligibility. Only federal student loans are eligible for an IDR plan. The direct subsidized or unsubsidized loan, direct graduate plus loans, and direct consolidation loans. If you have older federal family education loans, they're sometimes called FFEL program loans or Perkins loans. They don't automatically qualify. First, you must enroll them into a direct consolidation loan on the Student Aid Gov website to make them eligible for the IDR plans. Now, ineligible student loans include private student loans from banks like Sallie Mae, Discover, or SoFi. Those can't be put on a federal IDR plan. Step 2, gather your tax information. The Department of Education determines your payment based on your adjusted gross income, AGI, and your family size. You will need your most recent federal income tax return or transcript. Now, alternatively, during the online application, you can give explicit consent for the IRS to co-share your tax data automatically, which speeds up the approval process significantly. Step 3 is to submit the IDR application online. You need to go to the official website, studentaid.gov, log in using your FAFSA ID, your federal student aid ID number, and navigate to the Manage Loans sections and select Apply for an Income-Driven Repayment Plan. The application says it takes 10 minutes, probably going to take you an hour and 10 or so. So you will need to confirm your family size, input or link your income, and select your preferred IDR framework, such as the SAVE plan, the IBR, or the PAYE plan. Now, here's a pro tip for homebuyers. If you aren't sure what specific plan will yield you the lowest payment, you can select the option that allows a loan servicer to choose the plan with the lowest monthly payment amount for you. Step 4 is, once submitted, the Department of Education routes the application to your specific loan servicer, like AidVantage. It typically takes 2 to 4 weeks for the servicer to process the paperwork and adjust your financial state. If you're planning to purchase a home soon, timing of this application is critical. But honestly, it takes everyone a long time. So get this in order and live with it a bit so you're not so pressured. Because the truth of the matter is, the underwriter will want to see everything in writing. There's no handshake or verbal confirmation or telephone call confirmation. The paperwork that the mortgage underwriters require are official payment adjusted letters showing the exact dollar amount, even if it's zero, and the expiration or recertification date. IDR payments are only good for 12 months. Every year you are required to recertify your income. If your recertification window falls right in the middle of your underwriting process, your payment could temporarily revert to the old standard 10-year amortization framework on your credit profile, throwing off your DTI numbers at the last minute. Always check your expiration dates before applying for your pre-approval for your mortgage. So just do this every 3 months, 6 months where you're in that home buying process. Now, missing that initial window feels like a setback, I know, but get this, it's entirely fixable. Mortgage underwriters look at your financial profile as a puzzle. If one piece changes, like your student loan payment structure, the rest of the puzzle can be adjusted to match. Now, to present the cleanest, most approving case to an underwriter while balancing a standard 10-year repayment plan and the necessary, perhaps, car purchase, you need a highly strategic 3-phase plan. Phase number 1 is pivot the student loans and fix the DTI. Just because you are on that standard 10-year plan doesn't mean you are trapped. You can apply to switch to an income-driven repayment plan at any time. See, this is why you watch to the end, all these little details and nuggets. The move is to log into the studentaid.gov website immediately and submit an application and switch from that standard plan to an IDR plan. The underwriting benefit is as soon as your servicer processes the change and issues the IDR approval letter, that new monthly payment replaces that massive 10-year standard payment on your credit profile. Even if you're already looking at houses, underwriters will accept this new documentation mid-process to lower your debt to income ratio so you can fix it. Phase 2 is the car purchase strategy. You want to minimize the damage here. Since probably a car is a non-negotiable for your income, how you acquire it dictates your future. Buy, do not lease. As we discussed, a car lease payment can never be admitted by an underwriter, even if it has 2 months left. A car loan, however, gives you flexibility. Prioritize the monthly payment over the total price. Usually financial advisors tell you to avoid long-term car loans like 72 or 84 months because of the interest. However, for a mortgage underwriter, the overall debt balance doesn't matter. Only the payment does. And taking a longer term can force that car payment to come down low as humanly possible. Keeping it at $300 a month instead of $500 saves a massive amount for your home purchasing power. Keep your credit clean. Buy the car before you start pulling the mortgage pre-approvals. And then do not touch your credit card balances or apply for any other financing. Phase 3 is you want to package the underwriters, let's call it a survival packet. When the file has $250,000 in student debt and a fresh auto loan, the underwriters are going to look for compensating factors to approve the loan. And this is how you build a bulletproof file for them. Number 1, document the car's purpose. Make it a job to income connection. Have your employer write a clean professional letter on company letterhead stating that a reliable personal vehicle is a requirement for your position. Or copy the official job description showing your travel requirements. Underwriters like to see that new debt directly supports the stability of your income. Number 2, aim for a conventional loan framework. because FHA loans will hit your DTI with that mandatory 0.5% of your total student balance. And so if it's $1,250, regardless of your payment plan, you must target a conventional loan. Conventional guidelines will honor your IDR payment statement, even if it calculates down to $0 or $50. Number three, build a cash reserve wall. If your DTI is sitting right on the edge of that acceptance, around 45 to 50%, the absolute best way to force an underwriter to say yes is by having reserves. Reserves are months of mortgage payments left over in your bank account after you pay down your down payment and closing costs. If you can show just 3 to 6 months of housing payments sitting safely in a savings account, the automated underwriting systems are significantly more likely to issue an approval despite your car loan. So here's the summary checklist for your plan. Number one, submit the IDR request on studentaid.gov today to get out of that 10-year standard loan payment. Number two, finance. Don't lease the car and push for the lowest monthly payment possible. Number three is to keep those credit lines quiet for 3 to 6 months while stacking up those extra cash reserves. Number four is to bring your IDR approval letter and car loan structure to a mortgage professional to run a formal conventional pre-approval. Homework. Yes, you have homework. Head on over to our free class, Home Buying Chaos Unwrapped, where you will learn who does what, why, when, and how, and why you should become educated on buying a home long before you step into that open house or click any internet button saying more information. There are 5 professions involved when buying a home, all of with their own licensing rules, regulations, corporate products. And like they are in your field, they are an expert in just their one area. And you have to know how to navigate this. And we are in your corner because we are not waiting to get paid when you buy the house. We're just here to help you navigate this complex web of rules and process. Also, just so you know, this information here is to help educate you so you can make the best decisions for you in your situation. We want nothing more for you than to be financially sound in your housing choice, know how to navigate the overlapping interests, and know who is in charge of the process. And here's a hint, it's not your real estate agent. From the team at the First Time Home Buyer Workshop, bye for now.